I just want to thank 1010 Data for inviting us to present on our new data set that we just finished up a couple months ago, actually. And thank you very much for having us. One of the things to think about also is that we've been working with, Equifax has been working with 1010 Data for about a decade now. We started off working with mortgage data. And it was an interesting start to the relationship because it started off with the idea that a lot of hedge funds, right in, say, the 2007, 2008, you might have seen The Big Short, et cetera, were looking at, like, what is the mortgage market? What is the subprime market? And what is going on here? And really the fundamental question came out. We were looking at loan level data and trying to understand defaults and prepayments, et cetera. But the reality of it is, loans don't default. Borrowers default on loans. So the more you can know about a borrower, the more you can create a predictive model to understand. So we started off with the private label securities market and went from there. And what we're presenting today is what we call the Analytic Data Set. So one of the things that's important about Equifax is we have a capital markets group. We're very unique amongst the credit reporting agencies that we have a capital markets group. So this is devoted to the idea of working with many folks, and I see a lot of familiar faces in the room, and trying to understand and evaluate securitizations and whole loan pools. And as I said before, we've been working with 1010 Data for about 10 years. In addition to the set that we're talking about today, we also have the private label set and CRI Direct for servicing. This is linked to the McDash set. I don't know if many people are familiar with that. And those are both available on 1010 as well. So what is the Analytic Data Set? It's an anonymous 10% sample of the US credit population. Anonymous is key. This is anonymous data, and it's 10% of the US population. So you'll notice that I'm not saying 20 million or 18 million, and that's because it's a dynamic idea. So it starts in July 2005, and continuously adjusts. So as more people come into credit in 2007, 2008, et cetera, they get added to the set. We keep those consumers, but we add to the set. That's why I don't use a term like 18 million or 20 million. It's 10% of the US population. And the other thing to understand is the way we set it up, and it's probably a little bit too detailed to go in here, but it's unbiased. So this is a very random 10% sample of the US population. We got to this point because of a lot of work, and my colleague here, Hank, is going to talk a little bit in the end about the work we've done for the New York Fed, the Consumer Credit Panel. Anyone familiar? Is anyone in the room familiar with that? They put out quarterly reports, and they use Equifax data to talk about the household debt and credit panel, it's called. No one? All right, there we go. We got a couple. So again, with this set, we start in July 2005 to present. And each consumer record contains what we call attributes and variables. So this is, when you think about an attribute is person 123 has a Vantage 3 score of 730 and lives in zip code 06883. Now, when you talk about trade line, this is where it gets really dynamic because many of you are familiar with attributes, and a lot of you in the room have actually worked with Equifax attributes. So that's percent credit revolving utilization, number of student loans you have, that kind of thing. This is where it gets different. Each trade line, so if you have one student loan, 2 auto loans, and a credit card, you're going to see these in a monthly time series over time from July 2005 forward, or whenever you join the set. So what this kind of gets to the idea is you're seeing how people pay on their debt. So this goes a bit to what Rama said earlier. You can do priority of payments analysis. You can do a lot of different things. And because we're talking about a granular level, you're also doing this analysis not necessarily national level, because you see a lot of national level slides. But really when you get into it, there's a big difference between how people pay in California versus Michigan versus New York, et cetera. And just to continue that idea, you're also going to come up with different loss curves for different types of assets. It's different in California, different in New York, different in Michigan again. The idea with the set is it's so granular, it's like a sandbox. You can do whatever you want with it. So let's see what we got here. We talked a little about the consumer and trade line variables. The output is, we can go via 1010 data. And I think it's important to also say that this is on 1010 data now. So this is not just an idea. If you want to sign up for a trial, you can talk to Perry and myself, and you can start looking at it right away. But before we get into that, it's kind of like, I think we need to see, how would you use this? You know, I mentioned priority of payments analysis, but really we designed this set to be very easy to create loss curves. Loss curves that you're going to use for marketplace lending, subprime auto loans, student loans in repayment in Michigan, whatever you want to do. And so you're going to be able to make these loss curves and put them into your cash flows, et cetera, and create risk models for regulatory purposes, because we like to think of this idea that, you know, you can create a better model and valuation and have an edge and be able to understand the value of assets better than your competitors. But also, many folks in the room work for broker-dealers or banks that have regulatory requirements and have also found that with some assets like mortgages, you can do a pretty good job with the data available. But when you get a little bit more esoteric, like a timeshare loan or manufactured housing even, it gets more difficult. What I'm suggesting here is you'll actually find those types of loans in the set. And because we're going back to 2005, you're seeing it all across the credit curve, and you're able to construct models that are very predictive. So you have that. The loan origination, a lot of folks have talked to us about this set because if you want to start originating a new type of loan that you haven't done before, you don't have the history. You don't have the experience doing deep subprime auto loans. This provides the information you need. Portfolio management and servicing, you know, again, creating risk models and understanding various sectors. The macroeconomics is actually an interesting one too, because we have a number of clients that are looking at this right now that are really looking at research because they've used information like the New York Fed panel or McDash data, information that is skewed, like in the case towards mortgages, or biased by itself. Since this is unbiased and you're looking at the whole population at a granular level, you can build from there. And it's a really exciting way to do macroeconomic analysis. And I always spit things out too quick. I'm just gonna, you know, one of the things that I'd like to do as we go through this is any questions up to now, because I'm gonna show you what the data looks like. But if anyone has any questions, feel free to just jump in. Mm-hmm.
Can the data, to what extent can this data be tied to securitizations? Like, can it be, I know it's anonymous, but like, is there a way to link that?
No, actually, sorry. There's only one data set, and it's one of the ones in the beginning slides. It's the private label mortgage securitization. That is linked to the securitizations. Even the McDash set is just a general mortgage servicing set. For this one of the things a lot of folks will do is create like cohorts. So they're going to go in and see that this deal is composed of X, Y, and Z, and 30% California and 20% Texas, and go in, because it's so granular, pull that out and see how that performed over time and create your loss curve based on that. In addition, you could also look into quarterly originations and see how they perform differently. So you want to see what I'm talking about from a data perspective now?
Quick question.
Yeah.
Is this also commercial or just U.S. consumer loans?
It's just U.S. consumer loans. There is an interesting aspect to it, though, that we didn't really give a lot of thought to, because you'll see it when I go through the fields, or when I put up the fields that are available in this set. We have something in there called a small business owner flag. So we have, Equifax has different sets from the small business, Hank, what is it, small business exchange?
Small business financial exchange.
Financial exchange, exactly. And we've cross-referenced those borrowers into that so you can see. So again, part of the analysis, you can go in and pull out those small business owners and see how they performed and how they perform differently on different assets. Anyone else before I show you what I'm talking about? All right, so borrower level variables. One of the things that's key here, and it was very big in how we built the set, we started off with an anonymous consumer ID. And then you have the idea of state. Now, one thing I think you'll all note is we go down to the zip code. So what does that mean? Like I was talking to some people earlier. If I'm interested in a certain geography, say I'm talking about hurricanes, and I'm looking at Miami or Harris County, Texas, I'm able to zero in on that geography and understand that I have a 10% representative population, which I think anyone in this room would argue that 10% is typically statistically significant. So you have that, and then you get into the credit activity part. So higher level items like inquiries, the age of oldest account. Some of you are familiar with these type of attributes. They're calculated. Number of account always satisfactory, number of accounts derogatory. That's how you get to the idea of consumers being, if you've ever worked with roll rate calculators, like 30 to current to 30, you could set one up for people that have always been current on their accounts versus people that are current now versus people that have had delinquencies in the past. You can do that. Again, you can look into bankruptcies, foreclosures, third-party collections, et cetera. On the credit side, at an attribute level, you have the idea of an Origination Vantagescore 3.0. If you're not familiar with 3.0, it's the newest Vantage score, and it follows a similar distribution as a FICO score. And we have that at the origination. So I say the origination of the loan, the current Vantage score, and then we also have what we call the personal income model. So that'll give you an idea of the income at origination. So you can see how these are the attributes that are associated with a borrower. Any questions on that? Next is the trade line level, which I think is the more dynamic. Yes?
So if the borrower relocated from one state to another or just changed zip code, do you consider it
Yep.
two customers? Or?
Nope. It's just, if you were looking at the set as a time series, you would see a change in zip code. Simple as that. So that kind of gets into another interesting thing that someone discussed earlier today with me, was you can actually see deltas, changes in areas or zip codes or states, the migration of better credit, worse credit, things like that. So it's about understanding the change over time in that population. And I thought that was kind of an interesting analysis because that could weigh into different asset classes that I'm not as familiar with, but commercial mortgages and things like that, to understand changes in a very statistical way of an area over time.
Pete, if I may.
Yeah, of course.
You'll still be able to know it's the same consumer though, even if the zip code or the state changes, that consumer ID does not change.
Yeah, I mean, one of the, that was one of the challenges we had when we were building the set, is to make sure that we track a consumer correctly over time. And then also to, go into the next part, the trade line, which is probably the biggest challenge of all. This is when I say one student loan, one credit card, one auto loan, one mortgage. It's a line for each. And it has this information in it. So, again, we get the consumer ID. We get the date open. Now, we get a little into the terminology, product type, and I'll probably go into that a little bit later, or I'll let Hank go into that a little bit later. But these are elements like current delinquency status, outstanding, scheduled payment amount. There's an interesting item here, which is called the actual payment amount. And this is kind of a dynamic thing, and if Equifax, we call it trended data, because you can start to understand how people pay. Do you make a minimum payment on your credit cards? Do you pay in full? Are you paying more than you owe on your auto loan? Now this brings in kind of an element that goes a little bit beyond credit and goes into more of an ability to pay concept. So by using certain things of scheduled and actual payment amount, you're getting more into the financial capacity idea, which is something that's a little bit different from credit in the past. The account types, one of the things I mentioned too before that's a key thing is the account number, right? Tracking over time is key because you can't use certain easy things. Like, in other words, like if I want to track a credit card over time, I don't just look at the account number because that changes. We've all lost our credit card or a mortgage, the servicing changes, so the account number changes. It's actually not a small thing to be able to understand from month to month, this is the same loan or is this a new loan? And that's one of the things we've already packaged into it, and it makes it very, very user-friendly. And the difference kind of between what we would call a archive set, which is kind of like just a dump of data, into something that's been arranged in a way so that you can use it efficiently. The other things that I'll point out here that we're still digging into, this is that trade line ID, by the way, is the narrative codes. So descriptors that will help you understand what type of loan is, because you'll see in the coming pages, we have first mortgages, auto bank loans, auto finance loans, student loans in repayment, et cetera. The narrative codes give you a better idea and a descriptor so that you can then segment out certain types of loans and do the modeling on. I'll pause here. Any questions on trade line and what I'm?
Yeah, I do.
Yeah.
Do you have this? Is this data available outside the U.S.?
No.
When you say you're available in Equifax's presence in whatever 10+ countries, is there some equivalent of this, or is this?
Well, it kind of goes to the fact that this is kind of Hank and my baby, and we only did it for the U.S. We haven't really thought about it. There are different regulations in other countries. I mean, it's conceivable that such a set could be set up for Canada, and that's about as far as I would even opine, given the privacy laws in Europe, like say in Germany or Spain and UK, where we have a big. Australia is a big question mark. Equifax acquired the largest credit reporting company in Australia, a year ago, 2 years ago, something like that. And that's some conversations we've been having too, but that's really a conversation. This is, as you'll see, and Victor will show it at the end there, this is a real deal and it's up and running.
And then I had one.
Sorry. What?
But back to the commercial one, I don't mean to belabor this point.
No, of course.
Is that kind of data on the commercial side even collectible? Does it exist? Like this level of information for businesses?
Yes. It's, and Hank, if I get this wrong, you'll correct me. Mm-hmm. There are repositories of commercial data, small business data, and they're administered in a similar way like a credit reporting company. People report to them, and they're about small businesses. There are a lot of limitations on use for those sets, unfortunately. And so, for instance, there's a great repository called the Small Business Financial Exchange. And it has great information about small businesses going back in time and everything. But there's a catch. Give to get. So if you don't contribute, you don't get to use it, that kind of thing. So I hope that answers your question. It does exist, but unfortunately, most people can't have access to it, especially in the investor community. Question?
Yeah, do you know who the lender is?
We do. We just don't tell you, unfortunately. That would be a very dynamic thing. In earlier versions, we had discussed using a scrambled member ID, as we call it. So you wouldn't know the member, but you'd be able to kind of identify cohorts of loans under that member ID. But that was subsequently scrapped because, let's be frank, we have to protect the contributors to our data set. And if you spend enough time, you could probably figure out lending club loans, that kind of thing, just because the characteristics and because of other data that's out there. So it's not in there. Yep.
So same for the servicers, you don't know that you use it?
Oh, yeah, we know it, but we just don't tell you. Yeah, no, I mean, it would be, I mean, I understand, and I think it would be very dynamic to do a servicer level analysis and understand the difference between servicers of various auto loans or even mortgages. But again, then that, if you had that information, then our kind contributors wouldn't like that, Yes, please.
I think TransUnion, they also have similar data set offering.
Mm-hmm.
To summarize, what's the key difference or what's new?
So this page.
I think they also have trade line data as well.
Yeah, I don't know that. I do know that, well, just off the top of my head, this goes to 11. No. This goes back to this goes back to July 2005. I don't believe theirs goes back as far, but actually, I might take that back. I think theirs goes back further. I mean, I think one of the key things is I wasn't under the impression that they had the same trade line level detail, that theirs was more borrower level variables, but I think the confusion might come into is we've limited the borrower level variables. So you'll see we don't have like a total student loan or a percent or a total mortgage because we don't need it. So in other words, they might have a lot more of what we would call attributes, but we don't need that because we're showing you the trade lines. If you want to figure out how much student loan someone has, count it up. It's right there. So I think that might be one of the differences. The other difference that I do not know about, and I probably shouldn't be comparing something I don't know about, but the idea that I put forward about linking trade lines over time, that's a challenge. When you think about it, it's just more than your credit card changing. It's student loans becoming consolidated, and the idea of tracking them over time is very challenging. Because a fundamental question when you look at a set like this is this loan the same loan as last month or a new loan? And I think that's one of the things we spent a lot of time on.
We probably spent the better part of 4 years perfecting that.
Yeah, and half of it's a joke too, because in some of the early versions, we are able to explain how you can link things over time, by the origination date and the balances and things like that. And our first client came back to us and said, yeah, well, if you know how to do it, why didn't you just do it rather than telling me how to do it? And so that's what we did here. Please.
Is there any data on inquiries?
Yes.
I must 12 months.
Yeah.
Yes. In theory, one thing we did leave out that we do in some of our other products is mortgage inquiries. Very specific. We didn't do that here.
Why is that?
I don't know. Did we freeze forget?
just felt that, we were really trying to, to give as much data as possible on the trade lines. And, one thing about mortgage inquiries too is that they tend to reflect a situation where a consumer is out shopping for a mortgage, so they may have actually 3 or 4 mortgage inquiries in a very short period of time, which actually we dedupe and consider as one mortgage inquiry. Whereas here, this overall inquiry number, though, is more reflective of, well, maybe they're getting turned down for credit.
Right, and that's kind of a.
And that you really don't, you may not see that in a mortgage inquiry or in an auto inquiry because of the way, the people behave differently. That whole shopping aspect. People don't typically shop for a credit card. The only reason they might apply for 3 credit cards is because they got turned down for the other 2.
And from a time series perspective, is that going to be like a rolling 12-month figure? Or is
Yeah,
that
it would be the prior 12 months as of whatever the date is of the file.
Okay.
So it would be 12 months as of, let's say, July 2017, and then the previous month would be 12 months as of June 2017, because it's a monthly series.
Mm-hmm.
Right.
The other thing that's I know a lot of people are excited about is, where is it here? We have age of consumer in bands. So people that are familiar with some of our mortgage sets, you see this age of oldest account and use it as a proxy for how long someone has had credit or how old they are. This is actual age. So you're going to be able to, like I mentioned before, when you're creating loss curves, you can do it at state, by credit band, by age band, by product type. The idea behind this is granular. I mean, part of the response, the other part of like the initial clients that started using this set were that they wanted a do everything set. Any question you have about consumers in the US, we can model and understand it, and you don't have to come to Equifax every time you want to figure out how HELOCs reset after the 10-year mark and what can I expect a default and delinquency to be. Any more questions? I'll move on to, yeah, oh, of course, I'm sorry, it's the light.
Sure, just wondering, like those consumer information, how many of them, roughly speaking, are kind of like a backward looking? When I'm looking at an account, a loan origination, like before that, like 24 months or 6 months, how many of those consumer information are available during that time span?
Yeah, so like backward looking. So
Basically, I'm trying to understand, for example, I'm doing research on underwriting standard for the entire society as a whole, things like that.
yeah, so some of the backward looking variables here would be, yeah, that doesn't work.
Well,
Oh,
I mean,
sorry,
in a
sorry, I
s-
have to go back a
In
page.
a sense, they're all backward-looking as far as the attributes are concerned, but if you wanted to like use these in a model, one of the things you'd be able to do would be say, okay, I want to model, I want to predict loans that were booked in 2009. Okay, so what you could do is look at these characteristics of that consumer as of 2009, and that would be in your model. You wouldn't look at today's, but you look at 2009 one, and then you marry that up with perhaps if you're looking to model autos, then you'd look at the auto trades that were also originated by that consumer in 2009.
Yes, I was just thinking, for example, with 2009 example, how much can I know about whether the borrower, the potential borrower, has like some serious delinquency like 2 years ago that might impact the lender's decision that we do not typically see from a concurrent data.
Well, you would still know, but you would
Right in
look,
there.
You could look at their trade lines, and then just go back in time and see, when was the last time they had a serious delinquency?
I see.
Because you would have data on that particular consumer back to 2005 or whenever they opened the loans.
I see. Okay.
Yeah, and that's, it's interesting too. I mean, one of the reasons why we do this as a monthly time series is because we tried it as a quarterly once. And the gaps cause confusion and problems. So we won't offer it anything except for a monthly time series anymore. So Hank, I'm going to turn this over to you to just run through these. We've got about 12 minutes left. I talked too much again.
Okay, sure. All right, so here we just have basically a sample of some of the variables or the attributes that we have at the consumer level, okay? We have number of accounts always satisfactory, number of accounts past due, and so forth. And what we're doing here is, this is, illustrative data. We're just showing, how these consumers actually improved over time between 2015 and 2017. Okay, some of them got better, some of them got worse. But it just kind of gives you an idea of the kind of comparison you can do, just to see, are consumers in a certain market getting better, getting worse, or you could pick out, let's say, mortgage consumers, or really any kind of consumer, and then look at these overall attributes just to get a sense of and you could obviously do this over, you could do this monthly over the time period as well. We just picked out two archive dates. Okay, any questions?
Yeah, how are people using this? Like, are you, I guess, are you selling this to like banks, for example, to make decisions on, okay, well, Americans are not renewing HELOCs, so, we should probably move into more of the durables category in terms of lending or leasing. Is that how they're using it?
That's how they could be using it. We really don't have any bank customers for this yet. We just unveiled this a couple of months ago. But, we have a couple of hedge funds using it, and, as Pete said before, the New York Fed is using a data set in principle, somewhat similar to this, in that it's, you know, consumers over time, it's time series data with attributes and trade lines. So they're using it for, you know, policy purposes and basic research.
Yeah.
Okay?
Yeah, I honestly think one of the major, the two clients that are using it now are very specifically in the investment world, and what they're trying to accomplish is to do a better job using granular data to create better loss curves that are more predictive, to be able to value both securities and whole loans, you know, because these customers are fairly agnostic. In other words, they're not a mortgage-only shop. Right. And you want to be able to do more than, yes, I want to understand more about mortgages and be able to look and see what VA loans look like, but I really, really need to solve for problems that I have, like unsecured personal loans. You know, I don't have the history with that. And, no, I think we have that.
Yeah.
Coming
All
up.
right, so here we have just an example now of what some trade line data would look like. Obviously, we have more trade line information in the file than what we have here, but basically you can see what's going on here is we have one consumer, okay, and then we have another consumer, and we're looking just at one trade, okay, and what we're saying, or we're looking at two trades rather, and what we're saying is that this is how this consumer behaved on these different trades. So we're showing you the archive date of the data, right? We're showing you the date that the credit card, these are credit cards and mortgages, when they were opened, okay? What type of instrument are they? Are they mortgage or are they revolving? This is the product category, so this is bank card, this is first mortgage, this is bank card. This is the score at origination, okay, which is really important because this would be the score for this consumer as of this date, okay? And you can see now here they opened up something else 6 months later, their score was slightly lower. So this was the score at this point in time, this is the score at this point in time. So that's important for modeling because you really want to know, well, okay, when this loan was originated or this credit card was opened, you know, what did that consumer look like? Here's the score as of today, okay? Here we have, we also have a terms duration variable in here from the trade line. Now, it doesn't mean, I mean, there is no terms duration on a credit card, but on auto loans and anything installment, you're gonna know how long at origination, how long that loan is written for, whether it's a long-term loan or a shorter-term loan. That could be very interesting, let's say in autos and even in mortgages, because you may have people behaving differently if they have a 15-year mortgage versus a 30-year mortgage, right? Okay, here's their delinquency status. Here's the delinquency status the last month. Here's their current outstanding balance, the credit limit or the original loan amount in the case of installment, the last time it was reported by the lender, which is important because sometimes lenders will stop reporting for some reason and then start reporting again. So this tells you how fresh and reliable the data is. And then here's your trade line ID. So this is one trade line, the second trade line, and the third trade line.
And I can't emphasize how important that piece is, actually.
Yeah.
It really is. It looks like just a nice little number on here, but that's a very difficult thing to achieve. You know, you'll notice actually there's one interesting here. We see have a consumer finance installment loan pop up here. So I'm going to suggest something just in that space where you're trying to understand, was this loan taken out to pay off these credit cards? I don't know, but you'll be able to see that in this set. Was this loan taken out for a different reason? You know, because especially in kind of like the marketplace loan, we hear a lot about debt consolidation, but you really don't have the insight into that. And this can provide a little bit more insight on how those types of customers behave and what they're actually doing.
And of course, there's a lot more information on each trade line. You have the narrative codes and, you know, all the variables that, you know, Pete showed you before.
Yeah, and this one is, I think, a really interesting one.
Yeah, this is basically, you know, how you might go about starting to build a model to project losses on, and in this case, it's unsecured loans that were originated in 2006. So what we've done here is we've taken all the loans, the unsecured installment loans that were originated in 2006, okay? We took their score at origination, and then we tracked the losses of all those loans over time as a percent of the original loan balance, okay? So what you can see here is that these, the better scoring, no surprise, the loans that were better scoring at origination perform better, and the more risky loans perform a lot worse. But what's nice about this is there's actually a very well behaved pattern here that you can actually use for forecasting. Because let's say, all right, this is 2006, so this is before the crisis, right? When things were pretty loose and the economy was pretty good. If you were in a period like that again, which currently we're not, but if you were, then you could say, well, let's project what the performance of let's say 2014 loans would be, knowing what we know here, right? And if the conditions were the same, you could pretty much expect the performance to be the same. Now you could add to this some other things. I mean, obviously this is a very simple model, it's just based on score. But you could add things like original term. You could add things like the original loan balance. You could add things like, from the consumer side of the file, what was their utilization on credit cards at the origination date. You could say, well, what were their total student balances if they had them as of the origination date. So all that stuff, since we know that these were booked in 2006, you pull out those attributes at that point in time, and they would add to your model. You could put them in your model and see if you get a better prediction than this.
Just going to hit this last one because we're nearly out of time. This is a very similar concept. As auto loan data becomes more available due to Reg AB2, the ability and the need to model at a granular level is going to grow over time.
Right, and again, here what we're saying is for auto loans, now we're comparing not only the difference in performance because of score, but we're also comparing the difference because of origination period, okay? You see that the loans that were originated in 2014 quarter one, okay, perform a lot better than the loans that were originated, let's say, in 2008 quarter one. Same score bands, right? And the same thing is true over here for it's even true for deep subprime loans. Vantage score less than 530. Same thing is true. So not only is the origination score important, but also the time period that the loans were originated. What was going on then?
Mm-hmm. And we're really close out of time, so I'll just probably say,
I think we got 2 or 3 minutes.
Yeah. Any questions so far? Any questions on the set? Rob?
You mentioned the FICO score distribution is similar to the average score distribution. Can we make similar inferences to does the FICO sometimes comparable to the average scores that
Well, the range is the same now. Vantage 3 now has the same top and bottom points as the FICO score. The odds to score relationship in the two scores is not exactly the same, but they're pretty close.
Can you distinguish like second lien mortgages and first lien mortgages in the data?
Oh, yeah.
Yes. Yeah, a second lien mortgage would be a product called home equity installment.
Yeah, we didn't really go into all the product categories, but in mortgages, you have closed end and revolving. In auto loans, you have auto bank, auto finance, auto lease. And then you have this other category where you can start to pick out, by use of narrative codes, very specialized bespoke loan types like I was talking about, like timeshare loans or other consumer obligations.
Yeah, and another thing that you would see when you look at the data is that loans originated by banks, either whether you're talking about leases or loans originated by banks, perform a lot better than ones originated by finance companies. You know, the GMAX and Ford Credit and those
Yeah.
folks.
But then you also have the other side of the equation, like drive time and things like that.
Yeah.
Question?
If you were a lender and had a portfolio of existing customers, could you actually, or applicants, could you actually get an indicator appended that says that this is my customer as part of this data set?
We haven't thought of that, but I mean, in theory, because we have to understand that everything is anonymized here, and your code's up there. The account IDs are really just made up numbers. We can link them back to real numbers.
Yeah.
It's not something we've really considered up till now, but yeah, I mean, you would call that. I would call that kind of like a peer comparison. So in other words, you could have your set in your loans, but in general, kind of like, it's like a Citibank of the world, they know what their loans look like already. So you would really want, like this, to be able to understand how you sit in a peer comparison type world with other people.
Right. I mean, you could take, if you're Citibank, you know what your footprint is, you know where you're opening loans at, in what areas. So you would just maybe do it by zip code and by vintage and score bands, and then you can do a comparison between your stuff and the market as a whole.
Yeah. Really the beauty of the set is, like I said, it's so granular, we haven't even started to scratch the surface on what you can do in reality, and how you want to look down to a zip code level and understand the dynamics in that zip code as being different from the dynamics in another zip code, or pull things up and look at things from state and MSA level. Because there are a lot of products out there, like credit trends that talk about zip codes and areas and even credit score bands. That's kind of not what this is about. This is about however you want it. You have really a sandbox to build whatever you want.
Yeah. The reason I put this graph up too is because yesterday when I was getting a little demo of how the 1010 data interface works and so forth and the software.
Oh, you actually ran this.
I actually saw this graph get created, and it was done for this vintage, and then we just changed the vintage to 2009, and it took a couple minutes to run going through.
Yeah.
How many terabytes of data.
And maybe Victor, just real quick, and a question. Go ahead.
Yes, this might be a little bit off topic, but
Yeah.
we all know Equifax has data breach
Mhm.
in the last few months. And do you think that's going to impact kind of the analysis you're doing in the next 18 months or 2 years? Do you have any insight on that? Like hackers leveraging data you have and trying to fake application and stuff?
I think it's a good question, and I really can't comment much about it. But I think the one thing to understand is the type of data we're talking about here is anonymized data, and so it really is very, very different from the idea of personally identifiable information. And this is the use of this data in this anonymized fashion has actually never really been an issue and is allowed, and I don't expect that to change at all. But how many? We talk about big data, and you guys will get the idea. Victor, what was it? 30 billion rows?
Yeah, 30.5.
So you can understand why we're working with 1010. 30 billion rows.
Yeah, and the interface that they have is kind of sort of Excel-like, but the difference is it's an Excel sheet with about a billion rows.
So hey, when you sell it to a hedge fund, do they have access to the actual database, or how is that? Are you selling it
The way we sold it to the hedge fund so far is we actually deliver them the physical data. They run it on their system.
3 terabytes.
How often is the data delivered? All
Oh.
the same time every month, or are you gonna have?
About the middle of the following month, like for instance, middle of October, you get the month end September data.
For everyone?
Yeah.
Yep.
Yeah.
So you could see, one of the ideas behind that too is you get the idea that if you're monitoring situations or as things change very quickly, you're really seeing things more up to date than any statistical or survey or anything like that. You're 30 to 45 days lagged. That's it. Very real time. Yeah, any additional questions? Oh, sorry, go
I
ahead.
have questions around that. So you had a bankruptcy and you had a foreclosure
Yes.
indicator, I think on that borrower level
On the
behavior.
borrower level, yes.
Are those binary variables or
Yes.
those 0-1 flags?
Yes.
Do you happen to have dates, or could you just go back and find out when that flag first tripped?
Well, you could put, yeah, you could go back in the database and see when the flag first tripped.
Mhm.
We have the dates, but they're not here.
Yeah, we do have the dates, but I mean, I think the only time you're going to find that an issue is because a bankruptcy stays in your file for 7 years. So if you're looking at the 2007 file, in theory, you might not be able, some of the earlier, you won't be able to see when
Actually,
it
it's 10.
occurred. Oh, 10 years, sorry.
10, but derogatory.
7 years on major
Yeah,
derogatory.
Major derogatory 7.
But-
Oh, so when you pull, let's say, a new 10% in 2017, consumer debt was
No,
contained
no,
in
we're
16.
not pulling a new 10% in 2017, though. In 2017, we have the same consumers as we had in 2005. The only difference is anybody that's in the data set that was not in 2005 gets added over time.
So it's a steadily, so that's why, again, like maybe I didn't even explain it that well. That's why we emphasize the idea this is a 10%, not a 20 million, not a 21. It's a constantly dynamic, because we need to understand, I mentioned to someone before that the first time we did, we had this great idea to take 20 million people in 2005 and just track them forward. And it was a great idea. It was awesome. Except for we didn't allow for any new entrants. And we had created what I call the Millennial Gap. We left out the entire millennial generation. But Victor, yeah, I mean, this is just to show you that this is
Yeah.
real and available in 30 billion rows.
Yes, I mean, we have all the variables that Pete talked about here, right? So you can see 13.7 billion, right? So then we can do an aggregation. It's just going to take a few seconds.
Mm-hmm. Yeah, again, like we said, we really set this up so that you can easily create loss curves. I mean, for everything down to the most granular level. I mean, the hierarchy of payments is there, and I think that Ron pointed out some very interesting observations on that and how that can be done and how you could potentially apply that in your investments and analysis.
Can I ask a question?
Yeah, of course, go ahead.
So I was thinking about your comment on the anonymous data set.
Mm-hmm.
So do you, or your internally, can you actually track back to, say, map a consumer to, like, say, Social Security? I was thinking how, otherwise, could you link different accounts?
We can do that. In fact, it's one of the things that we're contemplating with SET is we have a subsidiary called the Work Number. I don't know if you're familiar, but it has actual employment and income data. And we could actually start, as opposed to like this talk of modeled income, we could actually start appending metrics that, again, are anonymized, but they give actual incomes and employment and salary versus hourly, job tenure. There's actually a very rich, and that would, just to be clear, that if we do this, and we're talking about it right now, it would change the whole idea of how you calculate DTIs, because you have actual incomes and you see all the actual debt. And at the same time, the coverage is about 30%. So it might look a little bit like a checkerboard, but a lot of people have told us that 30% actual income is a lot better than zero.
Sorry, what was that account?
So here is the number of records for each month. Right, so starting in 2005, July 2005, all the way to, I think it's last month. Yeah, August 2017. So
like 10% of the U.S. population is 30 million, right?
Mm-hmm. Well, actually, because that's me shorthanding things. To be in the set, you're not part of the population, you're credit active. In other words, we don't, if you don't have a credit card, you're not, in the Equifax file. So
This is a chart of the number of records.
Records, yeah.
Probably would be the number of trades for each consumer.
Exactly. So this is the number of accounts.
Yeah.
And actually, I think this is an interesting observation in itself. We all heard about deleveraging.
Yep.
Well, guess what? There it is. So you don't have to just trust what you read on Bloomberg. You can actually see it yourself.
Sorry, one more question. Just
Yeah.
to confirm, you said 10% of population. Do you mean 10% population or 10%?
10% of the credit active population. So this is a number that's more like
Yeah.
18 to 20 million.
So because if you sum on the population, it's basically if I've been sampled, it's all my history. If you do only on sampling on transaction, it maybe means only part of my transaction is being paid, but not my whole one.
But
That's different, right?
yeah, and
So by population or by transaction.
the other part to consider too, which is kind of morbid, is people do become credit active, but people actually die too. So they fall out of the set. Or like you saw there, the idea that you cut up all your credit cards because you were fed up and you just delevered.
Really cool.
Cheers. Hey guys, thank you so much. I'm so sorry we went over, but really appreciate it. Thank you.